Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Hangzhou TIGERMED Consulting Co. Limited annual report. Hangzhou TIGERMED Consulting Co. Limited provides a wide range of businesses and services to support the drug development process. The company offers contract research organization, CRO services, including clinical trial operation services such as clinical pharmacology, registration and regulatory affairs, scientific affairs, medical translation, and pharmacovigilance. In addition to these core services, Hangzhou TIGERMED also provides supporting services directly related to clinical trials, including clinical operation, data management, statistical analysis, and laboratory services. The company's preclinical development services include medicinal chemistry, compound screening, DMPK, safety and toxicology, bioanalytical and formulation research and development. The company's clinical development services are equally comprehensive, encompassing medical writing, clinical monitoring, regulatory affairs, decentralized clinical trials, and site management. Hangzhou TIGERMED also offers specialized services such as vaccine clinical trial services, multi-region clinical trial services, and medical device/in vitro diagnostic services. Furthermore, the company provides a range of additional services including medical imaging, quality assurance, GMP and medical device consulting, central laboratories, functional services, recruitment management, EDC cloud-based system, and remote follow-up center services. In the post-marketing phase, Hangzhou TIGERMED offers clinical research solutions such as site identification and selection, central monitoring, project team management, vendor management, and SAS project management services. Overall, Hangzhou TIGERMED Consulting Co. Limited is a one-stop shop for pharmaceutical companies seeking to develop new drugs or medical devices. The company's extensive range of services ensures that clients receive comprehensive support throughout the entire drug development process. Hangzhou TIGERMED Consulting Co. Limited market capitalization of $52 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Hangzhou TIGERMED Consulting Co. Limited holds a significant advantage in their industry. Hangzhou TIGERMED Consulting Co. Limited trades at a lower price-to-earnings ratio of 36 times and a lower price-to-book ratio of 1.53 times relative within the industry. This makes the stock valued slightly lower than its peers in the industry. This likely suggests that investors are less interested about the company, or it could be that the stock have not caught up to the industry valuation and should further be investigated. The balance sheet appears very conservative, with liabilities representing only 14% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline are multifaceted and influenced by various market trends and industry dynamics. On the growth side, several factors contribute to the increase in revenue. The recovery of the domestic biopharmaceutical industry has led to a surge in demand for clinical research outsourcing services. This is further fueled by growing investment and financing in the primary market, resulting in cash flow generated from new drug sales. Additionally, the consolidation of the clinical research outsourcing industry with benign competition has also contributed to revenue growth. The expansion of overseas business, particularly in the CTS segment, has also been a significant driver of revenue growth. This is attributed to the company's strong business development capabilities and relationships with high-quality clients. Furthermore, the introduction of new platforms and services, such as the Smart Medical Inquiry Platform and AI Intelligent Translation Platform, has also contributed to revenue growth. On the decline side, several factors have led to a decrease in revenue. The fluctuating demand for biopharmaceutical R&D in China, intensified competition in the industry since 2022, and optimization trend on the supply side have all contributed to revenue decline. Additionally, the decline in average unit price of domestic clinical operations, bookings, and cancellations of domestic innovative drug clinical trial projects due to customer funding issues have also impacted revenue. The slowing or reversal of trends in R&D budgets, outsourcing, and investments has also led to a decrease in revenue. Furthermore, failure to obtain necessary regulatory approvals and failure to meet customer expectations have also contributed to revenue decline. Net income experienced significant fluctuations between 2024 and 2025, with a notable increase of 119.2% from the previous year. However, this growth was short-lived, as net income decreased by 16.4% to Rm 1,873.2 million in the following period. The CTS segment saw an even more substantial decline of 30.2% YoY, while the net income in another segment decreased by a staggering 58.5%. On the other hand, there was a notable increase of 51.2% in net income from RMB 664,461,508.3 to RM 3,215,119.99. Profit margins also underwent significant changes during this period. The gross profit margin decreased by 6.6% from 34% to 27.4%, while the margin of net profit attributable to the owners of the company increased by 6.9% from 6.1% to 13%. However, the margin of net profit attributable to shareholders saw a decline of 7.7% from 12.9% to 5.2%. The gross profit margins in specific segments also decreased, with CTS segment experiencing a significant drop to 20.1%, and CRLS segment seeing a decrease by 3.9% to 34.1%. The reasons behind these changes are not explicitly stated in the provided text, but it can be inferred that various factors such as market conditions, operational efficiency, and competition may have contributed to these fluctuations. The company's financial performance indicates a significant milestone, the generation of positive operating cash flow. This achievement is evident across multiple sections of the financial report, specifically noted on pages 28, 58, and 61. The presence of positive operating cash flow signifies that the company is able to cover its operational expenses from its current revenue streams without relying on external financing or debt. This is a crucial indicator of a company's financial health and stability, as it demonstrates its ability to sustain itself over time. The company's debt level and interest expenses have undergone significant changes over the past year. In terms of debt level, the total borrowings decreased by a substantial amount of Rm 192,488,891.54 from 2024 to 2025, indicating a reduction in financial liabilities. This decrease is also reflected in the short-term borrowings, which dropped by 1,400,996,436.38. However, long-term borrowings saw an increase of $186,911,054.70. Regarding interest expenses, there are mixed signals. On one hand, interest expenses decreased by 3% from RMB 76.8 million to RMB 74.5 million, indicating a reduction in financial costs. On the other hand, interest expenses increased from $38,067,033.32 to $99,901,804.83, suggesting an increase in financial burdens. Overall, while there are conflicting trends in interest expenses, the company's debt level has decreased significantly, indicating a potential improvement in its financial health. The performance of the company's segments can be analyzed based on the provided data. In terms of growth, both clinical trial solutions and clinical trial services showed an increase in revenue from 2024 to 2025. However, a closer look at the numbers reveals that clinical trial services performed better than clinical trial solutions. Clinical trial services saw a significant increase in revenue, rising from $3,178,139,885.72 in 2024 to $3,266,805,018.61 in 2025. This represents an increase of approximately $88,665,132.89. In contrast, Clinical Trial Solutions experienced a more modest growth, with revenue increasing by around $141,014,319.68 from $3,494,980,277.06 to $3,565,995,596.74. Despite the better revenue performance of clinical trial services, both segments showed a decline in gross profit. Clinical Trial Solutions saw their gross profit decrease from $1,302,499,687.73 in 2024 to $1,217,051,289.13 in 2025. While Clinical Trial Services experienced an even more substantial drop, with their gross profit decreasing from $939,513,529.40 in 2024 to $656,143,010.45 in 2025. Overall, the data suggests that Clinical Trial Services were the stronger performer between the two segments, with a higher revenue increase and less significant decline in gross profit compared to Clinical Trial Solutions. Management is optimistic about the company's outlook and strategy. They expect domestic innovative drug clinical trials to improve in 2026 due to industry recovery and rebounding demand. To capitalize on this trend, the company will focus on collecting service fees from domestic pre-revenue biotech companies. The company has been expanding its scope to include new therapeutic areas such as medical aesthetics, which has led to a significant increase in clients and projects. In 2025 alone, they added 40 new clients and initiated 70 new projects. This growth is expected to continue with the expansion of relevant teams in key overseas markets. Management is committed to attracting globally experienced talents and industry experts for global expansion. They are also strengthening cooperation with top clinical trial institutions through the eSite program to improve management and efficiency. Additionally, they will continue to drive biopharmaceutical innovation by making minority investments in innovative startups. The company's strategy involves diversification and expansion, which requires investing in upgrading services and technology, optimizing branding and marketing efforts, and expanding employee resources. They also plan to make selective acquisitions and investments to grow their business. Furthermore, management is focused on attracting and retaining globally experienced talent to support their global expansion plans. Overall, the company's outlook is positive, with a focus on growth through diversification, expansion, and innovation. The company has made significant moves in its business operations through acquisitions and divestitures. In terms of acquisitions, the company has consolidated two subsidiaries, Shanghai BioQuick Pharmaceutical Supply Chain Management Co., Limited, and TIGERMED Beijing Co., Limited. This consolidation is likely aimed at streamlining operations and improving efficiency within the organization. The acquisition of these subsidiaries demonstrates the company's commitment to growth and expansion through strategic business moves. By consolidating its subsidiaries, the company can better manage resources, reduce costs, and enhance overall performance. The company's financial activities have been notable in recent years. One significant development is the payment of dividends to shareholders. For the year ended December 31, 2025, a proposed final dividend of RM0.26 per 10 shares was declared. This demonstrates the company's commitment to rewarding its investors through regular payouts. In addition to paying dividends, the company has also engaged in share buybacks. A total amount of RMB 500 million to RM1 billion was allocated for this purpose. This strategic move aims to boost shareholder value by reducing the number of outstanding shares and increasing earnings per share. That concludes the financial summary for Hangzhou TIGERMED Consulting Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.